Hello student, welcome to the lecture on balance of payment, and after this lecture we will be able to learn the following objectives. Understand the concept of balance of payments, study about the parts of BOP accounts, understand the concept of monetary policy, study about profit analysis and gross and net profit, understand the concept of break-even analysis. Let us begin by understanding the meaning of balance of payments. The balance of payment is an accounting of a country's international transaction over a certain time period, typically a calendar, quarter or year. It shows the sum of the transaction, purely financial ones, as well as those involving goods or services between individuals, businesses and government agencies in that country and those in the rest of the world. Every international transaction results in a credit and a debit. Transactions that cause money to flow into a country are credits, and transactions that cause money to leave a country are debits. Balance of payment may be used as an indicator of economic and political stability. For example, if a country has a consistently positive BOP, this could mean that there is significant foreign investment within that country. It may also mean that the country does not export much of its currency. The BOP statement divides international transaction into three accounts. Current account. The current account is used to mark the inflow and outflow of goods and services into a country. Earnings on investment, both public and private, are also put into the current account. Components of the current account are merchandise. Trade consists of all raw materials and manufactured goods bought, sold or given away. Services include tourism, transportation, engineering and business services such as law management, consulting, accounting, etc. are recorded in the service category. Income received include income derived from ownership of assets such as dividends on holdings of stock and interest on securities. Unilateral transfer represent one-way transfer of assets such as worker remittances from abroad and direct foreign aid. In the case of aid or gifts, a debit is assigned to the capital account of the donor nation. The capital account. The capital account is where all international capital transfers are recorded. This refers to the acquisition or disposal of non-financial assets, for example, a physical asset such as land, and non-produced assets which are needed for production but have not been produced, like a mine used for the extraction of diamonds. Capital transfer include debt forgiveness and migrants transfer goods and financial assets accompanying migrants as they leave or enter the country. In addition, capital transfer included transfer of title to fixed assets and the transfer of funds linked to the sale or acquisition of fixed assets, gifts and inheritance taxes, debt duties, uninsert damage to fixed assets and legacies. Acquisition and disposal of non-produced, non-financial assets represent the sales and purchases of non-produced assets such as the rights to natural resources, and the sales and purchases of intangible assets such as patents, copyrights, trademarks, franchises and leases. The financial account. In the financial account, international monetary flows related to investment in business, real estate, bonds and stocks are documented. Also included are government-owned assets such as foreign reserve, gold, special drawing rights, SDRs held with the International Monetary Fund, private assets held abroad and direct foreign investment. Assets owned by foreigners, private and officials are also recorded in the financial account. The Balancing Act. The current account should be balanced against the combined capital and financial accounts, but this rarely happens. We should also note that with fluctuating exchange rates, change in the value of money can add to BOP discrepancies, liberalizing the accounts. The rise of global financial transaction and trade in the late 28th century spurred BOP and macroeconomic liberalization in many developing nations. With capital and financial account liberalization, capital markets began to grow, not only allowing a more transparent and sophisticated market for investors, but also giving rise to foreign direct investment. For example, investment in the form of a new power station would bring a country greater exposure to new technologies and efficiency, eventually increasing the nation's overall gross domestic product by allowing for greater volumes of production. Liberalization can also facilitate less risk by allowing greater diversification in various markets. Now we will move further and we'll study about the monetary policy. Monetary policy is the process by which the monetary authority of a country controls the supply of money, often targeting a rate of interest for the purpose of promoting economic growth and stability. Official goals usually include relatively stable prices and low unemployment. Objectives of monetary policy. Monetary policy is not an end in itself, but a means to an end. It involves the management of money and credit for the furtherance of the general economic policy of the government to achieve the predetermined objectives. Various objectives or goals of monetary policy are neutrality of money, price stability, economic growth, exchange stability, full employment. Instruments of monetary policy. The instruments of monetary policy used by the central bank depend on the level of development of the economy, especially its financial sector, reserve requirement. The central bank may require deposit money banks to hold a fraction or a combination of their deposit liabilities, reserves as vault cash and or deposit with it. Fractional reserve limits the amount of loan banks can make to the domestic economy and thus limit the supply of money. Open market operation. The central bank buys or sells on behalf of the fiscal authorities, the treasury, securities, the banking and non-banking public that is in the open market. One such security is treasury bills. When the central bank sells securities, it reduces the supply of reserves. When it buys back securities by redeeming them, it increases the supply of reserves. The deposit money buys, thus affecting the supply of money. Lending by the central bank. The central bank sometimes provide credit to deposit money banks, thus affecting the level of reserve and hence the monetary base. Interest rate. The central bank lends to financially sound deposit money banks at a most favorable rate of interest called the minimum rediscount rate MRR. MRR sets the floor for the interest rate regime in the money market, the nominal anchor rate, and thereby affects the supply of credit, the supply of savings and the supply of investment. I hope you understand this concept that I just explained. Now we will move further and study business cycle. The recurring and fluctuating levels of economic activity are that an economy experiences over a long period of time. The 5 stages of the business cycles are growth, expansion, peak, recession, contraction, through and recovery. Economic growth is not a steady phenomenon, rather it tends to exhibit a pattern as follows: an expansion of above average growth, a peak, a contraction of below average growth, a trough or low point. The troughs then are followed by periods of expansion and the cycle generally repeats, though not in a regular manner. These fluctuations in economic growth are known as a business cycle and are depicted conceptually in the figure. Indicators of the business cycle. The National Bureau of Economic Research (NBER) relies primarily on indicators such as the following: employment, personal income, industrial production. Additionally, indicators such as manufacturing and trade sales are used as measures of economic activity. After studying about business cycle, it will be easy for you to understand the concept of profit analysis. In managerial economics, profit analysis is a form of cost accounting used for elementary instruction and short-run decision. An important part of profit analysis is the point where total revenues and total costs are equal. At this break-even point, the company does not experience any income or any loss. Components of profit analysis. The key components involved in profit analysis include selling price per unit, level or volume of activity, total fixed cost, per unit variable cost, sales mix. Assumption in profit analysis. The profit analysis incorporates the following assumption: unvarying sales price, unvarying variable cost per unit, unvarying total fixed cost, unvarying sales mix, units sold equal units products, application of profit analysis. The profit analysis is helpful in simplifying the calculation of break-even in break-even analysis. Besides, it is generally helpful in simple calculation of target income sales. Moreover, it also simplifies the process of analyzing short-run trade-offs in operational decision. Method adopted for profit analysis. The main method adopted to carry out profit analysis is the profit volume ratio, which is calculated by dividing the shareholders' contribution by the sales and then multiplying it by 100 as follows. Profit volume ratio equal to shareholders' contribution by sales into 100. Limitation of profit analysis. Profit analysis is a short run and marginal analysis which presumes the unit variable cost and the unit revenues to be constant. This is, however, appropriate for small deviation from current production and sales. Besides, the profit analysis also presumes a neat division between variable costs and fixed costs, though in the long run all costs are variable. Therefore, for longer-term profit analysis considering the complete life cycle of a product, it is preferable to carry out activity-based costing or throughout accounting. After studying about profit analysis, we can move ahead and study about gross and net profits. Gross profit. The difference between the total revenue and total cost is called gross profit. Gross profit arises after deducting all expenses of production from the total income. Thus, it is the excess of total income over total cost of production. There are various components of gross profit which have been given as wages of management. Entrepreneur performs certain tasks for the management of the firm. If this task is done somewhere else, then he will be rewarded for it. Thus, from gross profit, his remuneration for management must be deducted. Thus, the element of wages of management is a part of the gross profit. Rent on. Entrepreneurs own land. Gross profit also includes rent that arises from the entrepreneur's own land used in his production of output. The entrepreneur in his production uses his own land, factory building, workers' sheds, etc., which could have given to other producer in return of rent. Thus, the rent arising out of his own land and building is to be subtracted from the gross profit to arrive at net profit. Interest on his own capital. The entrepreneur has also got his own capital which he invests in the production of output. He never takes interest from the employment of his capital. His gross profit therefore includes the interest on capital provided by the entrepreneur. Thus, interest on his capital must be deducted from the gross profit. Net profit. Net profits arise because a function of a person as an entrepreneur. These functions are risk-bearing ability, production innovation, etc. Thus, net profit is the excess of revenue over it and implicit cost of production. After deducting all explicit costs from the gross profit, the residue forms the net profit. Profit may be negative or positive. Net profits include 5 components which are explained as payment for risk and uncertainty. Every business involves some amount of risk and uncertainty, and entrepreneur takes risk in the business. Thus, is rewarded for risk bearing. This reward is included in net profits. Reward for bargaining ability. The entrepreneurs having good bargaining power can employ cheaper factors of production, thereby reduce their cost of production, so they earn more revenue and hence more profit. Reward of innovation. Innovation means introducing new method of production in production. By introducing newly invented techniques in production, an entrepreneur reap widespread profit than others. The reward for having introduced innovation in the production is included in the net profit. Monopoly gains arise due to the nature of market. Such a market condition, the entrepreneur can pay lower prices to the hired factors. It can charge a higher price of its product as enjoys the exclusive power of producing that brand of output. In monopoly, the profit is definitely higher. We also exclude such monopoly gains from gross profit. Chance gains. Profit may arise due to certain chance factors. In such a case, no amount of an entrepreneur's effort has been made to reap such profit. Due to sudden rise in demand for a commodity will raise the price, thereby giving rise to windfall profit. This type of profit is not included in net profit. Thus, in order to arrive at net profit, this windfall gain is to be subtracted from gross profit. Gross and net profits gave us a glimpse about the profits of an organization. This section we will enhance our understanding about the profits. Normal profit. Normal profit is the reward of entrepreneurial effort. Normal profits are defined as the minimum income that an entrepreneur must earn in order to induce him to remain in the current business or industry. This profit is a fixed amount which is included in the cost of production. Normal profit is thus an incentive to produce output. This product arises due to the function of the entrepreneur. At this profit, no existing firms leave the industry, nor any new enter the business. Firm or the producer neither expand nor contracts business at this normal profit. Normal profit occurs to a firm in the long period. This long period profit is more for less stable and almost remains constant. Supernormal profits. These are the profits earned by the entrepreneur in excess of normal profits which form a part of the cost production. Supernormal profit, or otherwise called abnormal profit, arises due to risk and uncertainty bearing in the business. It also arises because of monopoly advantage and chance factors. Normal profit arises because of the introduction of innovation. An entrepreneur earns constant windfall profit so long as the same innovation is not introduced by others. Abnormal profit disappear when the innovation is universalized. Chance factors also fetch abnormal profit. No amount of human effort is made to earn this abnormal profit. Abnormal profit arising out of chance factor is short-lived. Break-even analysis is a technique widely used by production, management and management accountants. It is based on categorizing production costs between those which are variable costs that change when the production output changes and those that are fixed costs not directly related to volume of production. Total variable and fixed costs are compared with sales revenue in order to determine the level of sales volume, sales value or production at which the business makes neither a profit nor a loss, the break-even point. The break-even chart is a graphical representation of costs at various levels of activity shown on the same chart as the variation of income or sales revenue with the same variation in activity. The point at which neither profit nor loss is made is known as the break-even point and is represented on the chart showed by the intersection of the two lines. Fixed costs. Fixed costs are those business costs that are not directly related to the level of production or output. In other words, even if the business has a zero output or high output, the level of fixed costs will remain broadly the same. In the long term, fixed costs can alter, perhaps as a result of investment in production capacity, example adding a new factory unit, or through the growth in overheads required to support a larger, more complex business. Examples of fixed costs: rent and rates, research and development. Variable costs. Variable costs are those costs which vary directly with the level of output. They represent payment output related inputs such as raw materials, direct labor, fuel, and revenue related costs such as commission. These include depreciation, where it is calculated related to output, example machine hours, maintenance, and certain labor costs. Semi-variable costs. If production rises suddenly, then some short-term increases in warehouses and or transport may be required. In these circumstances, we say that part of the cost is variable and part fixed, and it is termed as semi-variable cost. Appraisals of break-even analysis. The main advantage of break-even analysis is that it points out the relationship between cost, production, volume, and returns. It can be extended to show how changes in fixed cost, variable cost relationship in commodity prices or in revenues will affect profit levels and break-even points. Limitation of break-even analysis include: it is best suited to analysis of one product at a time. It may be difficult to classify a cost as all variable or all fixed, and there may be a tendency to continue to use a break-even analysis after the cost and income function have changed. Disadvantages of break-even analysis. Assume that sales prices are constant at all levels of output. Assumes production and sales are the same. Break-even charts may be time-consuming to prepare. It can only apply to a single product or single mix of products. Moving towards the last in this chapter, we will now study about the exchange rate. The price of one country's currency expressed in another country's currency. In other words, the rate at which one currency can be exchanged for another. Fixed and flexible rates. Under a fixed exchange rate system, the government determines the rate at which the domestic currency is exchanged with foreign currency. The flexible exchange rate regime is diametrically opposite to the fixed rate system. Under this, the exchange rate is determined freely by the market mechanism without any interference from central bank. Thus, the forces of market constantly determine the exchange rate. The exchange rate regime matters This is illustrated by figure which shows the estimated impulse responses to a 1 standard deviation shock to the real exchange rate during the fixed and flexible regime period. This graph is computed using annual data and a specification with 2 lag. Variance of the real exchange rate data can be broken up into 2 components: the volatility of exogenous shocks and the persistence in the rate at which the effects of shocks die out. Finding indicates that approximately 2/3 of the rise in variance as our sample countries move from a fixed exchange rate regime to a more flexible rate regime can be attributed to a rise in the persistence at which shocks die out rather than a rise in the variance of exogenous shocks themselves. This finding underscores the importance of studying long-run dynamics and not just short-run volatility in isolation. Finding also offers a way to reconcile the 2 parts of the long-standing PPP puzzle. Monetary models with sticky prices are good at explaining real exchange rate volatility but not its persistence, whereas real models are good at explaining real exchange rate persistence but not volatility. Now, in the end, let us summarize what we have learned in this lecture. Balance of payment is an accounting of a country's international transaction over a certain time period, typically a calendar, quarter or year. It shows the sum of the transaction, purely financial one, as well as those involving goods or services between individual businesses and government agencies in that country and those in the rest of the world. The account is used to mark the inflow and outflow of goods and services into a country. Earnings on investment, both public and private, are also put into the current account. The capital account is where all international capital transfers are recorded. This refers to the acquisition or disposal of non-financial assets, for example, of physical assets such as land, and non-produced assets which are needed for production but have not been produced, like a mine used for the extraction of diamonds. In the financial account, international monetary flows related to investment in business, real estate, bonds and stocks are documented. Monetary policy is the process by which the monetary authority of a country controls the supply of money. The difference between the total revenue and total cost is called gross profit. Gross profit arises after deducting all expenses of production from the total income. Net profits arise because of function of a person as an entrepreneur. These functions are risk, bearing ability, introduction of innovation, etc. This net profit is the excess of revenue over it and implicit cost of production. Price of one country's currency expressed in another country's currency. In other words, the rate at which one currency can be exchanged for another.